Just to be clear, it's not a downward trajectory in values, it's a slowdown in the rate of growth. So we're still seeing really strong readings in the market, just not as fast a pace of growth as what we're seeing towards late March. So things just seem to be cooling down, but in the context of averages, this is still a really hot market. We're still seeing, for example, Sydney housing values are rising at more than 2% month on month, which is well above average. A lot of people like to annualize these numbers. Annualize a 2.3% growth rate, you're getting well above 20% growth in a year. I think things will probably slow down further from here because arguably, or I think everybody would agree, the housing market can't sustain a rate of growth that's that exuberant. If you look at some different ways to measure housing markets, you've got a really simplistic measure at one end of the spectrum, which might be something like a median price. A median is just simply the middle sales observation for any properties that transacted over a given period in a given region. And then you can go through the spectrum of sophistication up to, say, a stratified median, then a repeat sales index, and then getting up to the really sophisticated methods like a hedonic regression methodology, which is a valuation-based method. It's more of a portfolio measurement. So we're estimating the value of every single property across the entire property portfolio. And by that, I simply mean every dwelling within, say, Sydney or every dwelling in Australia. We estimate the value and we remove any properties where we've seen a change in their attributes, which may signal a capital injection in the markets. We're trying to remove any sort of evidence of a capital injection or a change in the property. So the portfolios remaining consistent, but also making sure we're not counting capital injections as opposed to capital growth. And then from period to period, we're simply measuring the delta change between the overall value of those underlying property valuations. One of the reasons why we see our hedonic index being utilized so much is, it is very sophisticated, very complex mathematics behind it, but also is very timely. We're publishing this index pretty much one day in arrears. And it avoids any sort of compositional bias that might be in the marketplace, like first home buyers, when they're really active, can actually drag other measures down because they're median price measures. So a compositional bias could skew price measures down. Because we're measuring the entire market, we don't have that compositional bias. It's very timely. We're getting about 80% of our property data prior to the government providing it to us as well. So thanks to our involvement with the industry. So for that reason, we can see a very timely measure of property values. We actually update that index daily, essentially running the same methodology day to day. So you can look at the intra-month movements as well as the end-of-month movements, which I think are equally as important, and start to see any sort of inflection points in the market, which is exactly what we're starting to see now. It's just this subtle slowing in the pace of capital gains, which started to become evident towards late March. So auction clearance rates peaked around the middle to late March at about 83% across the combined capitals. And as we started working through April, it was clear that clearance rates were just starting to move through a curve, coming down generally up around the sort of mid to high 70% range. Again, averaging this out on a weighted basis across the capital cities, we're still generally seeing Sydney up around the low 80% to the high 70% range. Just last weekend, Canberra's clearance rate on the preliminary numbers was about 97%. So Canberra not really slowing down all that much, but Melbourne is now drifting down into sort of the mid 70% range as well. All these clearance rates are still quite strong. I think they're still very indicative of prices continuing to rise. We know historically there's been a very strong correlation between auction clearance rates and housing market activity and the pace of capital gains. But if this trend persists, then I think it's pretty clear that it's another sign that the pace of capital gains is slowing as we see auction clearance rates coming down a little bit. It's probably fair to say that since Easter, auction numbers are also coming down a little bit, which is seasonal. So typically Easter marks a bit of a turning point in auction markets, moving into the cooler months. They don't start to pick up again until sort of the middle of August and then really start ramping up in September. So there's going to be a little bit of seasonality creeping in here as auction markets cool down a little bit with the seasons. But I think we've seen evidence for 4 weeks now where clearance rates are cooling enough to call this a trend.